An amortized bond is a type of bond that is issued with a predetermined repayment schedule for both the interest and principal. Unlike some other types of bonds, where the principal is repaid in a lump sum at maturity, amortized bonds gradually pay off both interest and principal over the life of the bond. This systematic reduction of the principal amount over time distinguishes amortized bonds from bonds with bullet or balloon payments. Amortized bonds offer numerous advantages for both investors and issuers, making them a popular choice in the fixed income market. Here are 25 advantages of amortized bonds. Predictable repayment. Amortized bonds provide a clear and predictable repayment schedule, which helps investors estimate future cash flows. Reduced default risk. Amortization reduces the principal amount over time, decreasing the issuer's risk of default as the debt is gradually paid down. Steady interest payments. Investors receive regular interest payments over the bond's life, providing a consistent income stream. Liquidity. The regular coupon payments from amortized bonds can enhance liquidity, making them attractive to investors seeking periodic income. Lower interest rate risk. Amortization reduces the bond's duration and sensitivity to changes in interest rates, mitigating interest rate risk. Diversification. Investors can diversify their portfolios by including bonds with different amortization schedules. Investor flexibility. Amortized bonds are available in various maturities, allowing investors to match their investment horizon and risk tolerance. Issuer flexibility. Issuers can tailor amortization schedules to align with their cash flow projections and financial goals. Easier valuation. The predictable repayment structure of amortized bonds simplifies valuation and analysis. Stable yields. Over time, the yield to maturity of an amortized bond tends to stabilize as the impact of changes in interest rates diminishes. Transparency. Investors can clearly track how the principal is repaid over the bond's life, enhancing transparency. Attractive to risk-averse investors. Amortized bonds are often favored by risk-averse investors due to their gradual principal repayment. Tax benefits. Amortized bonds can offer potential tax benefits for investors seeking tax-efficient investment options. Steady income for retirement. Amortized bonds can provide retirees with a dependable source of income during their retirement years. Less volatile price movements. Amortized bonds tend to have less volatile price fluctuations compared to bonds without amortization. Reduced reinvestment risk. As amortization returns principal to investors, reinvestment risk is lowered since investors receive back their initial investment. Easier financial planning. The fixed repayment schedule of amortized bonds facilitates better financial planning for both issuers and investors. Lower interest expense for issuers. Amortization reduces the issuer's overall interest expense as the debt is paid off over time. Long-term stability. Amortized bonds contribute to the long-term financial stability of issuers by systematically retiring debt. Reduced pressure on future finances. Issuers benefit from the gradual reduction in debt, alleviating future financial strain. Enhanced creditworthiness. As amortization reduces outstanding debt, issuers' creditworthiness may improve, leading to lower borrowing costs. Attractive to conservative investors. Conservative investors who prioritize safety and regular income often find amortized bonds appealing. Suitable for liability matching. Amortized bonds are used to match future liabilities, such as pension obligations or insurance claims. Ideal for long-term projects. Issuers funding long-term projects can structure amortized bonds to match project timelines. Less complex pricing models. The regular principal payments of amortized bonds simplify pricing models compared to bonds with irregular cash flows.